Today we're gonna be talking about Candlesticks masterclass with video. It's gonna be the #1 requested video. Everybody always asks me, what do you do whenever you see a chart? And how do I understand these candlestick charts? And what am I looking at? Furthermore, let's get started to the video. And before we start this video, make sure y'all leave a like, comment down, and share this video. Do me a favor. I don't usually ask for favors. Do me that favor and make sure you enjoy the rest of this video. Go grab your snack. Let's get into the video. So, Candlestick Masterclass for beginners. What is trading? A trader tries to make a profit by entering into trades by betting price movements by anticipating the future price trends as correctly as possible. It's possible to bet on rising and falling prices to make a profit. Traders use various methods and tools to analyze price charts and stock prices. So we got, first thing, a fundamental trader. The fundamental day trader who tries to make trade decisions based on company or economic data or economic news. Second, we got the technical trader. The technical trader only analyzes share prices and focuses on patterns, price formations from trends, candlestick patterns, market conditions, behaviors, and volume. And they usually back test on candlestick history. So what is trading? Traders buy 10 shares Apple for $175 on the left. So they buy all the way down here at $175. Well, the next day, Apple stock jumps to $188 on the right. So boom, we see Apple stocks up here. So for the price from $175 to $188, that's a $13 difference. So we subtract $188 minus $175, that's $13. So we got 10 shares of them. So we multiply 13 times 10, and that'll be a $130 profit. That's how you calculate your profits. The more you enter in a trade and the more you exit. We enter at 175, we exit at 188. Short-term versus long-term trading. Well, Kevin, what is short-term versus long-term trading? Short-term trading, the trader opens and closes their trades within a few minutes or hours. Long-term trader, when the holding period of position for a few days or weeks or even months. Day traders often less suitable for employed people due to time constraints, since it's often necessary to keep an eye on price charts throughout opening hours of the market. So that means that day traders usually don't be into the 9-to-5 jobs, because whenever they're in a job, they want to be focused on that job itself and that only. Job employees don't like people on their phones or looking at other things or away from whatever they have assigned for the people that day. What is technical analysis? Identifying profit opportunities by analyzing price movements of financial instruments. So these people, they analyze prices on financial markets moves, among other things, because millions of people and institutions interact on the international financial market every day. So what we see in people buying and selling whenever the market opens, every second, every minute, every hour, you can get it. You can get the trades. Technical analysis is effective because people always have the same behavior pattern, often make their trade decision collectively based on similar emotions. Introduction to candlestick analysis. Candlestick charts made of a solid body, a wick, and a candlestick shadow. So what is a candlestick chart? It's made of so-called price candlesticks. These candlesticks are made of different components to describe the price movements of financial instruments. So when you see a candlestick, it's just showing you different price movements on a graph that's happening every second, every minute, every hour, or every day. They got different time frames that candlesticks pop up on. Candlesticks are color-coded to illustrate the direction of price movements. Green candlesticks usually represent rising prices, while red candlesticks represent falling prices most of the time. So pay attention to where it opens and closes, because sometimes where it opens and closes shows you the direction where price is going. Sometimes green doesn't always mean rising, and sometimes red doesn't always mean falling. So this is a candlestick right here on the graph. On the left, we got the high, which is the wick right here. We got the stick of the popsicle, and we got the low of the popsicle, the candlestick. So right here in the middle is we got the where our popsicle is actually at. You know what I'm saying? We got our popsicle standing on the stick. So we got the body. This is called the body. So price opened at the bottom of the popsicle and of the candlestick, and ended up closing at the top of the candlestick. So boom, this right here is showing that prices is going up. So open up here, end up closing up here, open up here, closes up here, prices is rising. So boom, on the right here, we got popsicle stick right here. It had the high right here and it had the low. So boom, price opens at the top of our popsicle, ends up closing at the bottom of our popsicle. So this is showing that price is falling. So it opens up here and closes down here, opens up here, closes down here, pop. Price is falling. So we got trends. Right here is an uptrend on the right. And what do you see mostly on this graph right here? We see mostly green candlesticks, mostly rising prices. So in the uptrend, we're going to see more bullish candlesticks than bearish candlesticks, red candlesticks. So right here, the bulls are in control because buyers are stepping in and pushing the price higher. So this is higher highs up here, higher highs, and higher lows, which are on the bottom. On the bottom, we got a downtrend. This is a correction. We see lower lows. Prices keep falling. And what we see mostly on the bottom is what color candlesticks? Red. So prices are pushing the price down. We got lower highs and lower lows in the downtrend. Bearish. This is a bearish market. Basics of candlesticks. If the size of the candlestick body increases over a period, then the price trend asserts and the trend is intensified. When the size of the body shrinks, this can mean that a prevailing trend comes to an end, owing into an increasingly balanced strength ratio between the buyers and the sellers. Candlestick bodies that remain constant confirm a stable trend. If the market suddenly shifts from a long rising candlestick to a long falling candlestick, it indicates a sudden change in trend and highlights a reversal. Length of candlestick shadows. A strong trend. During a strong trend, candlesticks bodies are often significantly longer than the shadows. The longer the trend, the faster the price pushes in upward trend. The candlestick usually closes near the high of the candlestick body, and this do not leave a candlestick shadow or have only a small shadow. Trend slows down. The ratio changes and the shadows become larger in comparison to the candlestick bodies. Sideways phases. Turning points are usually characterized by candlesticks that have a long shadow and only short bodies. Long shadows can be a sign of uncertainty because it means that the buyers and sellers are strongly competing. They're fighting, but neither side has been able to gain the upper hand. Short shadows indicate a stable market with little instability. Increasing fluctuation indicates that the battle between buyers and sellers is intensifying and strength ratio is no longer as one-sided as it is during the trend. So we want to pay attention to the length of the candlestick shadows. Have to tell the candlestick is bullish or bearish. On the left, we got a gravestone doji. So price was at the top, at the highest down up here. And we have price at the lowest up here where it closed. So this is a bearish candlestick right here. And we got the long legged doji. Price went up to the highest and it went down to its lowest. And it ended up just closing in the middle. So this is a sign that it's a tie. It's a tug of war. Tug of war price is just standing. Now we got a gravestone doji. Price opened at the bottom, it went down to its lowest, and then went up to its highest price and ended up closing towards the highest. This is a bullish candlestick, trying to push the price up in this one right here. So, strength of a bullish and bearish candlestick. The most bullish is on the top, and the least bullish will be on the bottom. So, the green candlestick, it opens at the bottom and pushes the price all the way up. Same thing right here. This is a hammer candlestick. Price open at the bottom and they push the price all the way up and end up closing at the top. They open at the bottom right here and end up going to the top, but they just end up closing in the middle on the next one. And this one right here showing indecision is getting least bullish as more as it goes to the right. Compared to the bottom where this is the most bearish, it opens at the top and end up going down and end up pushing the price down. The next candlestick, it opens at the top and ends up closing at the bottom. This is a reverse hammer. This is a bearish candlestick. Same thing to the next candlestick. It ends up closing at the top and it ends up closing at the bottom, and it just stays right in the middle. The next one ends up closing at the bottom, but it ends up just staying in the middle. So it's showing that indecision. It's a nice reversal candlestick. These two are nice reversal candlesticks. Even though it's red, this is actually a sign of a hammer candlestick. It's actually a bullish candlestick. Even though it opened at the top, it went all the way down to the bottom, but it ended up closing at the top again. So this guy, like I was saying before, even though that the price, the color of the candlestick is red, it doesn't always mean that price is going down. Because this right here is showing that price is trying to go up higher. Same thing with this one right here. It opened at the top, ended up going down the bottom, ended up closing at the top again, showing that price is going up further. And these two right here showing that price, even though it opened at the bottom and went to the top, it ended up closing at the bottom. So it's not as bullish as y'all think. Buyers aren't as strong in these two candlesticks. Sellers are, because they closed at the bottom. They didn't have enough strength to push the price up. Whenever you want to look at a candlestick, you want to see the position of the body. If you see only the one dominant shadow that sticks out is one side, and the candlestick body is on the opposite side, then this is a sign of a projection, hammer, pinball. Indicates that although the price has tried to move up in a certain direction, the opposite of the market players has strongly pushed the price in the other direction. The most important single candlestick patterns. A candlestick with two equally long shadows on both sides are relatively small. Body shows an indecision candlestick. The buyers have tried to move the price up while the sellers have pushed the price down. The price ultimately returned to the start opening point. So this is a nice sign to see whenever a reversal is happening, because it's showing indecision. Either side can take control, the buyers or the sellers. You will see this candlestick near a bottom of a range or somewhere where a reversal will happen. The long-legged doji, the dragonfly doji, the gravestone doji, and the four-price doji. Doji candlesticks are important whenever you see trend reversals. So watch out for these candlesticks. The most important single candlestick patterns you need to know. The pin bar has only one long shadow which sticks out to the one side. The body of a pin bar is at the opposite end of the shadow. This candlestick has a large or small body as long as price does not leave a second shadow. A pin bar after a long uptrend signifies an intimate sell-off listed under trend reversal candlesticks due to an existing trend coming to an end. So boom, we got a bullish candlestick right here on the left, and then we see a bearish pin bar indicating that price is going to fall just because it hit the top, but price cannot stay that high. So a lot of resistance was happening, and then boom, it pushes the price down. Now boom, we see a bearish candlestick happen, like indicating price is going down, but boom, it opens at the bottom, then boom, they push the price up, and the next candlestick is showing a bullish candlestick. So this is a nice bearish reversal indicating price is going higher. While on the left was showing that buyers are in control at first, then boom, they hit the top. Now it's a whole bunch of resistance. Now sellers start shorting the market, and the price is falling. On the right, we got a hammer candlestick. Price opens at the bottom, goes at the top, and it stays at the top. So indicating that price is having more strength to close higher and higher. Compared to the inverted hammer, where the hammer is flipped upside down. So price opens at the top, ends up closing at the bottom, indicating that price is falling. The hanging man. The hanging man also is a trend reversal candlestick. An uptrend in the candlestick with a long downward shadow means that interest in selling has suddenly increased and sellers have managed to move price down sharply. The highest price of the day is at the top of the candlestick wick, and the lowest part of the day is at the bottom of the candlestick wick. Imagine your candlestick as your popsicle. You see this popsicle showing the lowest of the day or the highest of the candlestick. And this is where the opening price is at the top, and this is the closing price. The Marubozu. The Marubozu candlestick consists only of a long candlestick body without any shadows. So you don't see no candlestick wicks on this. You don't see no popsicle lines. This straight ice cream. It's just straight popsicle. So when you see this, when you see these type of candlestick, it shows increasingly strength towards the buyers or the sellers. So this one right here is a bullish Marubozu. No stick, no popsicle stick on it. Straight strength. That it opens low and it's up closing high. This is showing you that a lot of buyers are in control. On the bottom, it's showing you that price opened at the top, the highest, ends up closing at the bottom. No wick, no popsicle stick. Straight strength where sellers are in control. This is where you'll see a lot of momentum or trend continuation candlestick. You want to see this in a healthy trend right here. The engulfing candlestick. It consists of two successful candlesticks where the second candlestick is significantly larger than the first. The second candlestick often resembles the Marubozu candlestick, which is a long body with no wick. So first you see a candlestick that's smaller, and then the second one you'll see a candlestick with a lot of strength. This engulfing candlestick pattern, there's strength going towards either side. So we might see, boom, a bearish candlestick where it opens at the top and closes at the bottom, showing that price is going down. Boom. Next one we see where it opens at the bottom and it closes high. So it ends up basically like squeezing, and boom, we see a high. We see a nice little triangle happening where it goes down, and then price just quickly just jumps up. The three black crows. The signal that the sellers are pushing buyers out the market formed consists of three downward candlesticks. So we're seeing that this is a nice seller candlestick where bears are in control. We see this three huge red candlesticks that where they open at the top and they close at the bottom, showing that price is just dropping. The three inside up confirms that the sellers have been pushed out the market is now dominated by buyers. The even star indicates a temporary pause in price movements and equilibrium between the buyers and the sellers. So boom, we got a long bullish candlestick first. Now boom, we see this little bearish candlestick showing that it's indecision. Now boom, prices eventually just drops, opens at the top and ends up closing at the bottom, showing that a trend reversal is happening. So now prices is falling after that first bullish candlestick, and then boom, two red candlesticks shows that price is dropped. At any given time, the price can either rise, fall, or move sideways in a range. Trends. If the market rises over a period, it's called an uptrend. If the price falls continuously, it's called a bear market, sell-off, or downtrend. A correction. Corrections are short movements against the price prevailing trend direction. During uptrend, corrections are short-term phases in which the price falls. So a correction is basically a dip after we see uptrends, because markets just don't move straight in a straight line. They go up, down, down, stay in the range, up, down, stays in the range. So we see that correction, a correction, sign of correction is healthy in an uptrend. Chart phases. Consolidations are sideways phases. Markets are indecisive but about moving in a certain direction. Breakouts. The buyers and the sellers are equal during a range. The strength ratio between the buyers and the sellers change during the range, and the one side wins the majority. The bulls or bears is what take control in a breakout. So the market stays in a range and the breakout occurs. Trend reversal. If a correction intensifies and continues, it can lead to a trend reversal and lead to a new trend. So we see a downtrend in this picture right here. Boom. We see a range. And then boom, we see a breakout. So it's showing that a trend reversal is happening. And this is what usually happens in market conditions. We start seeing prices fall, and then we start seeing a range occur, and then we start seeing a breakout. This is right here is a triple bottom chart pattern. See the downtrend. We see the price hits our support level 3 times. First time's not a charm, the second time's a charm. Usually the third time's a charm. Now boom, it breaks out our resistance. The support is where price hits our line where we see the most touches, and it eventually doesn't break that support level. And this resistance is where we have at the top, because they can't push the price above it. But the third time, they eventually pushes it up. So we buy right here, boom, ends up buying. They start pushing the price up, and we can sell right here. So this is a nice support and resistance strategy. Make sure y'all check out my support and resistance strategy in my last video. I have that video linked in the bottom so y'all know how to draw your support and resistance lines. Chart patterns. We got a downtrend, and we got a range, and then boom, a breakout, uptrend. So I like to call this the little W. Boom, price starts to fall, and then we start to see in the range between our knuckles, and then boom, the breakout. This right here is a double bottom. Boom, this downtrend that curious at one time, and then it acts like it's gonna break out one time, but we have to hit that support level one more time. Boom. Sometimes it goes lower, and then the breakout occurs. So a lot of double bottoms don't look perfect, but this is basically how market structure usually looks whenever we're in a nice, healthy pattern whenever we see in the market. I hope y'all enjoyed this video. Make sure you comment any questions that you have. You want me to have another discussion, make sure y'all join the Discord. Every Saturdays I will be having a live with students who want to learn stocks and have any questions about options trading. All for free in my Discord. It starts at 9 p.m. Central Time on Saturdays. Make sure you hit the link in my Discord and y'all join up and y'all start taking notes, and we can get your journey started to be a profitable trader. Make sure you hit a like, you share with your sisters. You know, maybe their birthday's coming up. Go ahead, show them a way that they can start making money. Put some more extra money in their pockets during inflation. Hope y'all enjoyed the video. Y'all stay safe. Much love. We out.
I've been smoking more rocks, trying to make it up to the spot, rooftop, yeah, gotta